In this lecture, we are going to make a brief overview of the topics contained in the trading psychology section of the course. At this point, it's almost a cliché to say that trading psychology is absolutely necessary for any trader to not only survive, but to succeed in the long term. However, most traders don't stop to wonder why that's the case, and if they do, they almost never go deep enough into the topic, which is immense. It's not only a deep and wide subject, but it is also quite interesting because it deals with the rather mysterious nature of the human mind and some weird aspects of it. It is also interesting to find out how the human mind became what it is today and the mechanisms that led to this transformation over thousands of years. In the trading psychology portion of the course, we are going to study two main topics, which are the prospect theory and the relevant cognitive biases that affect traders the most. The prospect theory earned a Nobel Prize in economics, and it was discovered by a psychologist who happens to be a reference in behavioral economics to this day. The prospect theory makes it easier to understand the contradictory nature of how our brain works when we expose it to decisions that involve risk. The heart of the prospect theory shows how we can display aversive or seeking behaviors to the same problem depending on how this problem is framed. This has a major impact for traders because we need to deal with this sort of thing every time a trade is made. The other part of the section about trading psychology deals with the relevant cognitive biases that tend to hinder a trader's performance if he's not aware such thing exists. Cognitive biases are primitive lenses by which we observe the world. They are second nature to us, and many of the activities that we perform on a daily basis and that we take for granted would be impossible without them. Things like learning, memory articulation and decision-making are deeply connected to the cognitive biases. The other attribute of cognitive biases is that all human beings have them without any exception. They precede personality in a way. That's how deeply embedded they are in our biology. As you will find out later in the course, the presence of the cognitive biases in modern society creates something called the intelligence paradox, which is one of those real-life ironies that spiral off of the complexity of our existence. It's quite easy to underestimate the effect of cognitive biases in our trading because they are silent to us in a way. The fact that we have a hard time seeing biases in ourselves is itself a bias called bias blind spot. Once again, that's because cognitive biases are primal intuitions deeply rooted in our biology, and they come from behind us in a way to shape the way we see the world. The study of these two aspects of our psychology help to clear up the fog that surrounds the unique behavior of human beings regarding risk associated with time, which is a major part of trading. In the next lecture, we are going to dig deeper into the prospect theory to understand its amazing conclusions about human psychology. In this lecture, we are going to study a critical aspect of human psychology applied to decision theory in the financial markets, which comes from the understanding of the prospect theory. The prospect theory is so important that it won a Nobel Prize in economics, and it was discovered by a psychologist, which is the man you see in this picture who happens to be a leading authority in behavioral economics. There are two modes of reaction a trader can have when facing a decision in the market, roughly speaking. The trader can seek risk, or he can avoid risk. The hallmark of the prospect theory is that it shows how a person can shift between these two modes regarding the same scenario. The only thing that makes the person shift between risk avoidance or risk seeking is how the decision is framed. In other words, the way in which a person sees a decision is what determines if she is going to seek risk or avoid risk. The interesting thing about this is that the person can shift between risk aversion or risk-seeking behavior just based on how the situation presents itself. That happens because human beings make decisions based on something called heuristics, which are simplistic and automatic decision-making rules that run automatically in the brain. These heuristics are effortless and second nature to us because human beings evolved over thousands of years with the need to make decisions in the quickest way possible, which does not mean these decisions will be made in the best way possible. These are two completely different things. The field of evolutionary psychology claims that our ancestors had to make quick decisions to avoid dangerous situations, and that's how these mechanisms got engraved in our nervous system. As we will see in future lectures, the presence of these heuristics and cognitive biases is a paradoxical practical necessity of our existence, but let's leave that to a moment where we can focus more precisely on why that's the case. For this lecture, it's important to understand the core and axioms of the prospect theory. The heuristics and biases associated with the decision-making process are wrapped by something called bounded rationality, which is composed of three elements. The available amount of information in the moment a decision is made, the time constraint that envelops the decision-making process, and the cognitive limitations of the person making such decision. In trading, all three elements of the bounded rationality are attacked in unfortunate angles. For example, the amount of information a person has to make decisions in the market is indeed limited. That's the problem that high-quality technical analysis attempts to solve, and it is already a big challenge by itself. The time constraint of the decision-making process is also a problem in the markets because traders are always running against the clock, which is a reliable way of augmenting the effect of negative cognitive biases and the overall anxiety level of a trader. The cognitive limitations of a trader are no different than the cognitive limitations of anybody else, but a trader tends to put himself in situations where his counterproductive biases get amplified. This almost always ends badly because our biases are not exactly designed to be rational. They are a byproduct of biological evolution to get us out of primitive versions of trouble. Once again, this refers back to the paradoxical nature of modern social animals like us with primitive cognitive biases. To truly understand what the prospect theory means in practice, we can do a few different exercises to show how we can seek or avoid risk depending on how decision-making questions are framed. Consider the two following alternatives and choose the one you prefer. Number 1. 95% chance of winning $100,000. Number 2. 100% chance of winning $94,499. Let your intuition guide you and pick one of the two alternatives. If you are like most people, you probably chose alternative number 2. However, mathematically, and statistically speaking, the alternative that makes the most sense is alternative number 1. Before showing you what that means, let me explain what this example means under the light of the prospect theory. The fact that we generally feel better choosing alternative number 2 shows us how we tend to avoid risk depending on how the question is framed. Most people pick alternative number 2 because of the fear of disappointment. However, statistically speaking, the correct alternative is alternative number 1 because 95% of 100,000 produces $95,000 over a series of equal decisions while 100% of 94,499 produces $94,499, which is less money. The key here is not to pay attention to what the numbers feel like gauged by our intuitions, but to use mathematics and statistics to discover what the decisions really look like over time. Most people choose the alternative that does not make sense under the light of mathematics and statistics because these things are not part of our intuition. Let's look at a different question to see other types of reactions people might have about this framing problem. Consider the two following alternatives. Number 1. 5% chance of losing $100,000. Number 2. 100% chance of losing $5,100. Once again, this is a question framed to spark risk aversion or risk avoidance. Most people tend to choose alternative number 2 simply because our intuitions guide us to the impression that it is better to leave with a certain small loss than to have the possibility of losing a larger amount. As correct as this might sound, it is mathematically and statistically incorrect. If we analyze these alternatives over a series of equal decisions, we will see that 5% of losing $100,000 makes you lose $5,000 over time, while 100% chance of losing $5,100 guarantees that you will lose $5,100, which is a bigger amount to lose, and therefore an undesirable outcome. After the first exercise, you already know that you should look at these problems using simple mathematics, so you probably picked the correct answer. However, it's amazing to notice how people choose alternative number 2 due to the fear of a large loss. These are the two classic examples of questions framed to provoke risk aversion in most people. Let's now look at two classic examples of questions that provoke risk-seeking behavior. Consider the two following alternatives. Number 1. 5% chance of winning $100,000. Number 2. 100% chance of winning $5,100. From the last two examples, you already know that you should look at this problem under the light of mathematics and statistics, and therefore, you should be able to see that the correct answer is alternative number 2. That's the case because over a series of equal decisions like this, 5% chance of winning $100,000 generates $5,000 while 100% chance of winning $5,100 generates $5,100, which is more money, and therefore, a more desirable outcome. However, as you might be expecting already, most people choose alternative number 1 in the hope of winning a large amount of money. In other words, by listening to their intuitions, most people end up seeking risk unnecessarily. Once again, most people choose the wrong alternative because they are thinking intuitively, not mathematically and statistically. Let's look at a final example that provokes risk-seeking behavior. Consider the two following alternatives. Number 1. 95% chance of losing $100,000. Number 2. 100% chance of losing $94,499. Most people choose alternative number 1 in the attempt to avoid a certain loss. However, we know that alternative number 2 makes us lose less money in a series of equal decisions like this. As you can notice by these 4 examples, the way decision-making questions are framed using different lenses of high or low probability, winning or losing scenarios, and high or low amounts of money deeply affect the way our heuristics lead us to make choices. It's only through the unbiased lenses of mathematics and statistics that we can erase this effect. Another interesting thing that the prospect theory points out is the asymmetrical shape of the utility function. In simpler terms, imagine that we can attribute a psychological value for wins and losses. The asymmetrical shape of a utility function tells us that winning $100 feels 100 points in the imaginary scale of psychological comfort. However, losing $100 feels more than 100 negative points in the same scale. In other words, winning $100 is not symmetrical to the experience of losing $100. There is a lot to be said about the relation between the prospect theory and the idea of using optimal risk-reward ratios over time in trading. Many traders feel uncomfortable with the idea of using a good risk-reward ratio because their win rates are diminished. That happens simply because it's a lot easier for the market to hit a small stop than to hit a large profit target. This is where the concept of trade location comes into play to save the day and balance things out. Let's observe the prospect theory in 2 distinct risk configurations in the market. One is a very irresponsible scalping paradigm in which the trader aims for an extremely high win rate, so his stop-loss orders are large, and his take-profit orders are short. The other risk configuration is a more sophisticated one where the trader maintains the ratios between 1:3 and 1:5. This naturally produces a lower win rate, but it guarantees the trader stays in the game indefinitely, unlike the first configuration that is short-lived. The main difference here is that the first risk configuration fails to recognize the importance of projecting decisions over time, which is the main thing that makes most people answer decision-making questions incorrectly. It feels a lot better to make quick and immediate rewards in the market, but that feeling does not last very long. On the other hand, the second risk configuration takes into consideration the mathematical and statistical side of the decision-making process and bypasses the erroneous intuitive feeling that comes from generating a lower win rate. One of the most important lessons a trader can learn is the maturity to grasp the idea that sacrificing an exceptionally high win rate is a practical necessity to make money in the long term. There is no way around the laws of mathematics and statistics. Now you know how your brain can trick you into making the wrong decisions based on what you feel instead of basing your decision-making device on what is universally accepted as reasonable according to mathematics and statistics. In the next lecture, we are going to explore something called the intelligence paradox. In this lecture, we are going to amplify our understanding of something called the intelligence paradox. This is somewhat a deeper notion about behavioral economics, so first we are going to see the paradox in its condensed form so that later we can unpack all the concepts and ideas that are necessary to its full comprehension. The intelligence paradox can be stated in the following sense. The same cognitive biases that enable the evolution of intelligence in the human brain are the same cognitive biases that hinder that intelligence in modern life situations. The paradoxical nature of this statement lies in the notion that the cognitive biases we have are in great part responsible for our survival over thousands of years of biological evolution, and at the same time, these cognitive biases often catapult us towards irrationality, and therefore away from what we consider intelligence in various examples of our modern social life. Before we can understand this idea more clearly, let's first define the idea of cognitive biases. Metaphorically speaking, a cognitive bias is a lens through which we see the world. This lens steers our thought process, behavior, and decision-making apparatus automatically, so most of the time, we are not aware of such biases. It's common to observe people believe that they are being completely impartial about a given subject, while from the outside, it's perfectly clear that they are biased. We have about 150 cognitive biases, and many of them are critical for the way in which we learn new things and for the way our memory works, which is another way of seeing the intelligence paradox. We need certain biases in order to be able to remember what we learn and recall the new acquired skills when we need to. However, when our biases interfere in our emotions, that's where we can get in trouble, especially when we're dealing with the financial markets. The great question here is why we possess these apparently counterproductive biases in the first place if they seem to cause more trouble than anything else. The problem is that the time span of the existence of modern society compared to the time span of the biological evolution of our brains is tiny. That means that for most of the time, our brains have been naturally selected to deal with primitive problems like avoiding dangerous animals in the wild, tribal fights and things like that. Only very recently we have been forced to learn how to deal with modern life situations like Trdaing, in which we deal with the faults of our own existence in a way. Our biases are very good for primal activities without which would be impossible to learn and develop memory. However, these same biases get in our way when we need to make decisions in an economic paradigm. As we saw in the last lecture about the prospect theory, the decision-making process of traders in the markets attacks the bounded rationality idea in unfortunate ways in all three angles. We have limited information to make decisions in the market, so right from the start, a whole branch of cognitive biases that deal with how we recall memory must be triggered in order for us to indeed make decisions. The second element of the bounded rationality, which is time constraint, also triggers a series of cognitive biases that deal with the notion that we must act fast in our decisions. Evolutionary psychology tells us that we develop this urge to make fast decisions due to the survival paradigm in which our ancestors lived. For example, if you were a human thousands of years ago, and you had to decide about the danger of facing an unknown animal, for example, the humans that made quick decisions were naturally selected over the humans that were not quick enough to make such decisions. Remember that fast decisions are not necessarily good decisions. Quick decisions are made for survival, but trading requires well-thought-out decisions. This is why every trader needs a trade plan, which is a way to make fast decisions based on well-thought-out ideas. This is so important that we define the trade plan as one of the dimensions of a professional trading strategy. The third element of the bounded rationality, which is the cognitive limitation of the decision maker, just sums up what we have been talking about in this lecture. Cognitive limitations can be understood as a combination of how amplified the biases can get with the addition of IQ, which is the cognitive ability to articulate and understand abstract concepts. It's important to notice that we all have the same cognitive biases as we are part of the same species, but our personalities vary greatly, and that serves as a catalyst to amplify certain biases and diminish others. If we bring these concepts to a more practical approach of the markets, we are going to notice that we do irrational things automatically, and that's an incredibly dangerous idea. Since cognitive biases are so deeply embedded in our minds, we don't notice when we are being biased, especially if we don't know there is such a thing called cognitive bias, which is the case of most traders that enter in the market. Just like the subtle points of view detected by the prospect theory, the biases control how our thoughts arise in consciousness and how these thoughts will be steered in a way. In this course, we will study most of the relevant cognitive biases that affect traders the most. By doing that, you will gain an edge over the traders who do not possess this knowledge. Another advantage of studying trading psychology more deeply is that we can take precautions that will enable us to avoid certain psychological pitfalls that are guaranteed to happen in trading. However, before we proceed to study the relevant biases one by one, let's solidify the notion of the intelligence paradox to finish this lecture. We already have a good idea of what cognitive biases are, where they came from, and why they are still sticking around with us to this day and will probably do for a long time. The intelligence paradox states that the Homo sapiens would not have developed high intelligence if these cognitive biases were not present to allow our species to survive long eons of time. At the same time, these biases tend to get in our way in modern life situations that are part of our complex social networks and hinder the intelligence they allowed to develop in the first place. That's the paradox. Intelligence could not have been developed without these primitive lenses to guide our ancestors to overcome their simple problems, but since our species did that sort of thing for a very long time, these biases were deeply engraved in our psychology, and now we must know how to deal with them in a different paradigm, which is the modern world. The problem is that these biases were built and naturally selected by the primitive world. It's almost if we had a primitive sleeping ape inside our minds at all times, and the wrong stimulus from the external world is enough to wake up this creature. The problem is that this creature has no idea how to manage its emotions and it acts completely by instinct and is driven merely by survival. That's the underlying psychological structure that goes on when you see a trader punching his computer screen out of anger towards the market. You can probably imagine that letting this metaphorical sleeping ape trade for you is a really bad idea. In the next lecture, we will begin the fascinating study of the cognitive biases and how deep these psychological traps can get. Availability heuristic is a cognitive bias in which a decision maker relies upon knowledge that is readily available rather than examine other possible alternatives to a given situation. It is easier for us to recall information which has recently arrived. The main application of the availability heuristics in trading lives in the difference between building a solid context for a trade and trading by impulse. Building the correct context for a trade situation involves a significant degree of patience and mental effort, but it is the only way we can access the necessary depth of analysis. Unfortunately, the availability heuristics is the natural state of our minds. We tend to use the information that is more easily available simply because it's easier, and we tend to avoid producing cognitive discomfort that comes from deliberating about the details of a situation. A trader who trades with the availability heuristic in an amplified state is not worried about the context of the market or what's happening in the battle between buyers and sellers. This trader only wants a simple trigger to enter and exit the market automatically. Hopefully that does not sound too familiar to you, otherwise you might have to train yourself to dial down your availability heuristic. The way to do that is to first recognize the existence of such bias, and the second is to accept that contextual trading is the correct way to approach the markets. The attentional bias is a cognitive dissonance that makes people be more influenced by their recurrent thoughts. Like the availability heuristics, the attentional bias can easily put traders off track by making them focus on the wrong things. For example, the recurrent thoughts of a trader might make him forget the context of a market for a brief moment. A classic example of this is the trader who watches the news while trading. As far as we can tell, watching the news is only a source of distraction that blurs the correct analysis of the market that it is usually accomplished silently and without external noise. Watching the news might give you the sensation that you are connected to the market. However, this is an illusion, and the sad reality is that, most of the time, watching the news is counterproductive due to the attentional bias. This cognitive bias reflects the tendency people have to start believing information that has been repeatedly exposed to them. In other words, if you hear or see the same information too many times, you have a natural tendency to start believing it, even if you are aware that such information is just an illusion. That becomes a problem in the financial markets when traders are continuously exposed to bad information on how to trade and on how to manage their emotions. The illusory truth effect is quite powerful in the financial markets because there is a lot of people spreading out misleading information about how traders should act. Due to the way our brains are wired, if we don't have a good theory about something, we will end up trusting a bad theory, which to us feels better than no theory at all. There are many ways to trade the market that seem reliable and trustworthy, but many of them are shallow and only look good on the outside. The illusory truth effect plays a big role in letting the wave of misleading information continue to grow. By becoming a little more aware of the illusory truth effect, we can begin to select the information that we use in our trading in a more efficient way. After all, defining high-quality context for your trading ideas is all about weighting information rationally. This is the tendency people have to attribute more meaning to information that is familiar to them. Once again, this spirals from the intersection between our pattern-seeking nature and our inherent need for survival. Trusting familiar information is also a key component in the learning process. In the financial markets, traders tend to display the mere exposure effect in a larger scale because most of the information about how price works is blurry, so it's easy to attach oneself to an idea that makes sense apparently. In other words, in the financial market world, which is chaotic and confusing to most people, a piece of information that makes sense is an unusually attractive beacon of comfort. Here you can see that the very nature of how mysterious the financial markets can be is already enough to mess with our cognitive biases in a counterproductive way. We must develop some kind of filter if we want to have a reliable approach to the markets. Comforting pieces of information like the idea that one can trade without risk, for example, are very attractive, but they are completely misleading, and only serve as a distraction. This is a familiar bias to most people who have some experience in the markets. The mood-congruent bias is when your mood affects the types of memories that are triggered in your mind. If you are a trader with a lot of bad experiences in the market, this can be a problem. If you happen to be this type of trader, even a certain type of market scenario can trigger really bad emotions if you are in a bad mood already. Needless to say, it's always better to trade in a relatively neutral state of mind. Too optimistic is not good because it can make you go after opportunities with no real context behind them based on a feeling of shallow hope and pure optimism. Excessive optimism has its place in certain aspects of life, but the financial markets are not one of them. Trading in a negative state of mind is also bad because it can drive you to a downward spiral and a negative cascading effect that usually ends badly. This is also known as the frequency illusion, and it refers to the effect of learning something and subsequently seeing this new thing everywhere. This is also common in the financial markets. It can be a problem when one type of market analysis blurs other necessary ways of seeing the market. This is very common among traders who can only trade using technical indicators. For example, a trader like this can only see the market through the light of one specific indicator, and he cannot begin to understand the market in a multi-layered fashion like we've been trying to do over this course. This is usually a reflex of having poor information about the market. One of the goals of this course is to make the Baader-Meinhof phenomenon a little looser by showing you how a market should be analyzed from different angles and different types of analysis. The empathy gap is a cognitive bias that reflects how people can neglect the impact of primitive impulses in their behavior and choices. For example, when a person is angry, it is almost impossible for this person to understand what it feels like to be in the opposite state. This works in a personal level as well as in an interpersonal level. For example, it can be hard for people to put themselves in the shoes of other people. The result is the underestimation of other people's feelings and an overestimation of our own feelings. We tend to overestimate our own feelings over the feelings of others simply because our own conscious experience is simply more interesting to us. We don't really feel another person's suffering. We can only feel empathy for it, hence the name of the cognitive bias. For the world of trading, since the interaction happens between a person and the price chart, the empathy gap occurs in the personal layer, meaning that the trader will underestimate how the primitive impulses we potentially display under extreme circumstances will influence our behavior and choices to a significantly important degree. One very good example of this is when a trader, who is usually not making use of any risk management methodology, finds himself in a losing streak that deeply affects the overall equity. Let's imagine that this trader was overloading positions, and because the trader was caught in a losing streak, the damage produced on the equity was significant enough to make this trader angry about the loss. Just the sight of the lost capital on the trading terminal is enough to keep the anger momentum going. This circular behavior eventually erupts in a fight-or-flight instinct resulting in violence like punching the computer screen or simply being in shock by the overwhelming reality of the recent events. There's no one to blame here other than the trader, of course. Some traders even try to blame the market in a ridiculous attempt of removing the guilt out of one's shoulders. It's unfortunate to think that what led this trader to this type of behavior is twofold. First, the ignorance about what can happen when traders don't use good money management. Second, the empathy gap on a personal level that made the trader misunderstand that when anger was emerging in consciousness, the correct thing to do would be to simply stop everything and reevaluate. Notice this is extremely hard to accomplish depending on how angry the trader is at the moment. That's why it is necessary that this process is ceased before it reaches a point of no return, so to speak. Some traders don't even know they can experience such emotions in trading. Once again, the first step for preventing this kind of situation is being aware that it can happen and how it happens exactly. There are a few traders that have experienced this many times, and they will continue to do so because they know nothing about the mechanisms that are at play here. It's possible that some of these traders even think there is some sort of psychological problem with them, but that's clearly not the case. It's not wise to exclude that possibility for all cases, but most of the time, the traders don't suffer from any sort of psychological illness. This is just what happens when primitive behaviors are fully triggered. If you think that studying trading psychology is boring, this last example might serve as a source of motivation to get through the boredom. In other words, taking a trading situation to such extreme is trying to apply the primitive wisdom of our ancestors to a modern-day paradigm. It's easy to see that this is absolutely going to fail 10 times out of 10. There is the need for the trader to develop a certain impartial attitude towards one's own emotions. This is a difficult process, and most people don't involve themselves with it because it requires a constant calibration of one's behavior towards everything else. Again, it's never enough to stress the importance of being theoretically aware of such possibilities. The trader who already had these experiences has the practical advantage of evaluating them in a personal way and in an isolated manner, but this doesn't mean it's necessary to have such experiences to really understand that they are bad and that they should be avoided. The best case scenario to prevent biases like the empathy gap and others as well is to never be subjected to the full practical potential of these biases, but only to be theoretically aware of them. There is no reason we should think that a person should be subjected to bad experiences in order to really understand what they mean. We must be intelligent enough to learn from the mistakes of others. If we relied on the paradigm that we should experience everything ourselves, it could take more than one lifetime to understand all these things we must necessarily understand to become consistently profitable traders. The omission bias can be categorized as the impression that harmful actions are worse than harmful inactions even when the outcome is the same. This can be easily transported to a trading scenario in the following sense. To generate consistent profits over time, the trader needs to take actions regarding a particular financial instrument. Depending on what type of personality the trader has, actions may be more natural than inactions and vice versa. Imagine that a trader that has more of an impulsive personality trying to trade a particular market with an exaggerated level of aggressiveness. Let's also imagine that the result of this endeavor is that the trader breaks even. In other words, the trader didn't change its capital because the sum of profits and losses during the period was equal to zero. Now imagine that a trader with a passive personality is being too passive about the market to the point that he barely trades at all. The outcome, of course, is break even. The outcome of both personalities is the same in this case. How can we really say which one is worse? We can't arrive at this conclusion objectively because we need to look at them from the angle of the outcomes. Sometimes it's better to be passive about the market, and sometimes it's better to be active about the market. The ideal scenario to be in trading is similar to sniper mentality that patiently waits but doesn't hesitate when the right moment arrives. Throwing shots at every single noise you hear would be amazingly wasteful and dangerous at the pace that never shooting at all wouldn't get the job done. Certain actions that appear to be good in the short term can have a disastrous effect in the long term. At the same pace, actions that feel counterintuitive in the short term can have a good effect in the long term. The essential point of this is looking at the outcomes considering the statistical significance of such actions like we studied in the risk management portion of the course and in the prospect theory lecture. This cognitive bias is also known as the isolation effect. When people are subjected to various forms of similar stimuli, or similar types of information, they tend to give more importance to the string of information that stands out the most. This is an obvious reflection of our pattern-seeking nature. This behavioral paradigm is so deeply ingrained in us that we do this automatically all the time. The von Restorff effect is one of the tools used by market makers to confuse retail traders in a subtle sleight of hand. There are many times in the market that large traders intentionally produce abrupt market movements to trigger the impulsive behavior of less advised traders and also to bring the attention to a certain part of the market while the most important parts of the market go unnoticed. This is one of the most cynical secrets about how large traders can literally manipulate the retail traders by using reverse psychology and a type of psychological flaw that is inherent in all human beings, including market makers, of course. The difference here is that market makers are fully aware of how such bias displays itself, and they are very proficient at triggering this sort of behavior in other traders. The focusing effect, as the name suggests, is when a person places an exaggerated amount of importance in one event inside a larger context. In the markets, the focusing effect can happen on a regular basis in various situations. The area where this tends to happen more often is when traders analyze their performance. The focusing effect can happen, and it's probably more toxic when the trade series under analysis is not large enough to produce statistical significance. For example, imagine that a trader makes 10 trades and uses these 10 trades to evaluate performance. Contained in all these trades are a series of losses and one disproportionately overloaded trade that made possible for the overall equity curve to have a positive result. The focusing effect would happen when the trader in question rationalizes his positive outcome just by the fact that it exists without considering how the trader got to that result in the first place. The way to do that is by just focusing on the large trade that probably had a great deal of luck involved in it. Traders under this paradigm tend to say things like, "I know I'm doing something right because I made profits quickly, and that wouldn't happen if I was wrong about my strategies." A statement like this is clearly mistaken if you take into consideration everything that is being said here. Namely, the trader is completely excluding the role of luck in the one trade that made the equity curve profitable. The trader is not considering the factors that led to his losses. The trader didn't use sound risk management to frame the trades. The trader is ignoring the statistical significance of the trading sample. The trader clearly wants to be proven right instead of being skeptical about the results. To achieve the status of being right in this context, the trader needs to reverse the approach. If we attack this trading sample from all angles and it survives, the trader is very likely to be right about the performance being good, otherwise he might be just misleading himself. The framing effect is the natural inclination people have to react differently to information depending on how it is presented. This phenomenon goes hand in hand with the prospect theory, where you have a mathematical explanation of how people tend to avoid or seek risk depending on how the question is framed. The problem is that mathematics and statistics are not intuitive to us. We need to force ourselves to think in these scientific terms. The prospect theory exemplifies this phenomenon in the simplest way possible. The key to understanding the true meaning of numbers and probabilities within behavioral economics is to extrapolate how a particular decision would affect your perception of the problem if this decision was made multiple times. This is, in more complicated terms, the concept of statistical significance. Just look at the expression statistical significance. The word significance is there to show that one simple isolated action carries no explanatory quality about its extrapolated value throughout time. This is the only way to understand these problems in their real sense. This cognitive bias shows the discrepancy between an individual's perceived change of something and the actual change of something. In basic terms, this law states that the relationship between stimulus and perception is logarithmic. In other words, if stimulus varies geometrically, perception varies arithmetically. This idea can be practically observed when a trader risks exponentially larger amounts of capital. The logarithmic relationship of stimulus and perception explains why a trader in that situation keeps doing what he is doing until he is forced to stop. In this case, the Weber-Fechner law explains the trader's reckless behavior. The logarithmic relationship says that if stimulus varies geometrically, which means that it will be multiplied by a fixed factor, the perception will vary arithmetically, which is to say in an additive manner. In practical terms, it would look something like this. Imagine a trader begins risking 1% of the capital, and this trader multiplies this percentage by a factor of 2 in each trade that is made. The series of trades would look like this: 1%, 2%, 4%, 8%, 16%, 32% and 64%. This represents the stimulus. However, the perception of the trader still functions in an additive manner respecting the original value, which was 1%. To the trader, it would feel like risking 1%, 2%, 3%, 4%, 5% and 6%. I said this explains the trader's reckless behavior, because to his point of view, no real significant change is being made in the risk. The reality of the situation is completely different, as you can see. This is one of those unfortunate realities about our minds that seem to have had advantages to our ancestors, but not so much in modern days. If you think about fights, for example, the Weber-Fechner law is very useful to the person who is losing, therefore it is a form of survival or defense mechanism. This might have been selected as a cognitive bias that helped our ancestors to survive uncomfortable stimuli. Individuals who had this bias obviously would have a better chance to survive than individuals who didn't have it. It's a natural way of numbing unnecessarily big perceived stimulus as a defense mechanism. This bias shows the inclination we have to search, interpret, favor, and recall information that confirms our pre-existing beliefs. This is a big one in the financial markets, and it's one of the main reasons that hold traders back in their road to success. The confirmation bias can be observed in the markets when a trader confirms his beliefs in a technique when it works and ignores this same technique when it doesn't work. This is obviously very counterproductive because in reality we must deal with both positive and negative sides of everything that we do. There is simply no escape from that. However, the confirmation bias poses a great opportunity depending on how we decide to approach it. For example, if we always try to see the advantages and disadvantages of a market theory or technique, we will be able to learn a lot about it, and also learn a lot about the market as well. This is actually one of the cornerstones of good contextual trading. When we look at the charts, we automatically form a bias about its future direction. This process is immediate, and we cannot really stop it. However, we can force ourselves to see conflicting possibilities of a market and observe which one of them plays out, and the reasons one context ends up winning over the other. The big lesson here is to be aware of the confirmation bias, and deliberately try to counteract it by embracing the negative sides of any given technique in an attempt to extract some good out of these negative sides by conflicting them with the positive sides of the technique. That's a surprisingly liberating thing to do. This bias refers specifically to the initial reflex people have when faced with new evidence that collides with pre-existing beliefs. What's interesting to notice about the Semmelweis reflex is that it is immediate and involuntary. In other words, when people are presented with new and compelling evidence that aims to destroy one's pre-existing beliefs about something, the immediate response is denial. The fact that it is immediate says a lot about the believing software of our brains. It's easy to recognize that this immediacy is counterproductive to several degrees, and yet, in real time we will tend to operate in this way indefinitely even after this recognition. The whole idea about denial is quite interesting. We see our minds and the beliefs it subscribes to as a fortress. The first reaction the guardians of the fortress have to external strange attackers is to counterattack instinctively. However, if the attackers use a different methodology, they might enter the fortress to convince everybody inside that they have been mistaken about their approaches. In other words, the way to effectively attack any held belief is through reason, not violence. I mean violence here metaphorically speaking, of course. Let me give you an example. If somebody says something like, "You're wrong for believing such a thing," your Semmelweis reflex will trigger immediately. You will feel it even though you might not show others that you felt it. However, if somebody approaches you and say, "Look, I think you should reconsider your belief in X because of this and that," the effect such approach has on your Semmelweis reflex is a lot weaker. In trading, there will be no one telling you that you're being stupid about anything. It's you against the market, and we already pointed out that the market is incapable of caring about your feelings, so you will be left with your thoughts to reflect about your actions. Speaking in practical terms, you will be against yourself when you are trading, and that's surprisingly difficult contrary to what most people believe. There are ways of triggering the Semmelweis reflex by yourself. Just imagine a trader who is getting consistently losing trades in the market. He's facing an extraordinary amount of evidence that suggests he doesn't have any good idea of what he's doing. Usually the response is self-denial, and here lies the big problem. As it is widely known, the easiest person to fool is yourself, so you will be capable of remarkably interesting feats of creativity to convince yourself you are not as bad as the results you are generating. Meanwhile, deep down you know that you might be too biased about yourself. The lesson here is to embrace your flaws as soon as possible and work your way up from wherever you are. It doesn't matter how bad it is. It's certainly better than keeping yourself in the vicious circle of self-denial. The bias blind spot is the ability an individual possesses to successfully identify biases in other people's behavior while failing to recognize his own biases. We can't erase these biases. What's important is to admit that you're going to be biased in one way or another. Ironically, this is the first step in going around such patterns of thinking. It's not really a matter of not being biased. It's a matter of discovering how you're being biased, which biases are taking place, and reducing the effect of such thinking patterns to a realistic degree. Just the simple sight of the illustration of the cognitive bias list is enough for us to realize that erasing all cognitive biases at once is far from being a possibility. The recognition of the bias blind spot is a great lesson in humility, and it serves to teach us how to evaluate ourselves a little better before judging other people's actions. It's part of the process of developing a healthy level of self-awareness. Clustering illusion is the tendency to mistakenly consider small clusters of information as relevant, like small winning or losing streaks for example, that will inevitably arise in data with low statistical significance. For example, if you randomly generate a small sample of trades, you will notice that small clusters of winning and losing trades appear. This can give you an illusion that this randomly generated strategy has some sort of quality. However, this is how data inevitably behaves. Let's take the example of a randomly generated series of trades where the risk-reward ratio is 1. Theoretically speaking, if you generate enough data to have statistical significance, the ratio between winning and losing trades is going to be 50%. However, if you generate a small amount of data, it can give you the impression that this randomly generated strategy has some sort of tendency. The first 10 trades of this sample could be winning trades for example. If you only analyze this small cluster of the data, you have the impression that the system tends to win more than it loses, which we know to be incorrect in this case. The clustering illusion, along with other similar biases, is the #1 enemy of successful risk management application in the markets. Since we also observed that trading without good risk management is a bad idea, we can understand how something very specific can have such broad consequences. If you're not able to go around your clustering illusion, you will fail as a trader. There is no other option in this case. I would say once again that this bias comes from our pattern-seeking nature. We desperately want to find patterns to understand the world around us, and we do this automatically. In fact, we must do it to a certain extent, otherwise we would need to relearn the same things every day. If we didn't have the capacity to form patterns, we would need to get a new driving license every time we stepped inside a car. In fact, just to get to the car in the first place, we would need to learn how to walk every time it was needed. The essential point is, pattern seeking is essential to learning, which is essential to life in general. However, obsessive pattern seeking can turn into things like the clustering effect. Naive realism is the idea that our senses are capable of always giving us access to the true reality of things. In other words, it's the idea that we can always trust our senses immediately without considering the possibility that we might be subjected by illusions of various types. This applies to the physical world and, more prominently, in the realm of ideas. It's a lot easier to be mistaken about ideas than to the appearance of a physical object, for example. Some people tend to trust their senses and their thinking too much to the point it begins to sound like arrogance. The fact that arrogance sounds bad to us goes back to the original idea of naive realism. If a person is being too confident about something, she gives the feeling that she is being negligent and that she doesn't care to be negligent about the fact that she might be wrong about stuff. It's comforting to see that most people react repulsively in the face of arrogance. This is a sign that arrogance has indeed bad effects in the long term, and we should avoid it to the best of our efforts. Naive realism can happen in trading as well. In fact, it is annoyingly common in any financial market. I've seen many traders move on from being intelligently skeptical about their abilities to being stubborn and unrealistically arrogant about them. Even if you are a very good trader, if you cover your set of skills with the wool of arrogance, your skills will wither eventually. This sort of thing can happen when traders are overwhelmed with the fact that they can make a lot of money in the market. The sad and ironic reality is that this initial arrogance covers the trader's eyes and catapults him back to the starting point, and he needs to earn his skills and equity back. In a way, the only set of tools we possess to really get in touch with reality is our senses and our reason. The subtler mistake is to trust anything immediately without engaging in any sort of investigation about our sensory and cognitive experience. It's amazing to see that we have such mechanisms, and it's incredibly liberating to see that we can choose to behave in certain ways. The bottom line is that we should be aware of the possibility of being naive about reality, and therefore, we should always be a little skeptical of ourselves to maintain this problem in check. The gambler's fallacy is one of the most common cognitive biases in the financial markets. The bias occurs when a trader believes that because losing trades happened more frequently than normal in a given period, winning trades will occur more frequently than normal in the future, in a sort of expectation that nature balances itself out eventually. This is demonstrably false. There is no compelling evidence that shows trades will balance themselves out in that way, because the probability attached to each trade is independent from every other trade, which is the same thing as saying that trades are not causally chained to one another. What happens is that actions only show their true nature when they happen many times in a row, and anything that can happen will happen if you wait long enough. Let's make an exaggerated example to illustrate this situation in a better way. Let's assume a trader has the firm belief that if he wins 7 trades in a row, he'll be absolutely convinced of his ability and therefore won't need any help from technical analysis tools or any other methodology. The trader with such belief probably doesn't know that even random trading strategies can produce way more than 7 winning trades in a row. The trader also probably doesn't know that anything that can happen will happen eventually, so at some point he will make 7 winning trades in a row. It doesn't mean he will prove his ability. Another toxic example of this is the application of martingale strategies that double the risk every time you lose, so eventually one win compensates all losses. The problem with such mentality is that virtually infinite capital is needed for this to work, and that's precisely what traders don't have. There is no rule that says the odds of making a winning trade increases as the current losing streak increases in size. That's the heart of the gambler's fallacy. Once again, there is no causal link between the probability of various trades. The probability of making a winning trade does not increase as you produce more losing trades.